When you take benefits from a pension plan, you get the option to take some tax-free cash as a lump sum. And when you pay into a pension, the government gives you tax relief. That's free money, essentially, on top of your contributions. So can you take the tax-free cash out of one, put it in the other, keep doing that, and maybe keep making money off the government? Hi and welcome back to the channel. My name is Pete Matthew and I'm a chartered financial planner based here in the UK, and this video is sponsored by Meaningful Academy Build Wealth. More on that a little bit later. Unsurprisingly, you can't take full advantage of what might seem like a loophole to get tax relief on top of tax-free cash paid out of a pension. That is called tax-free cash recycling. And I get what you might think is a surprising number of emails asking questions about this. So I want to put a little counter on the screen here for every time I say the words tax-free cash in this video. I've already said it 4 times, so let's start the counter there. Now, the rules on tax-free cash recycling are fairly simple. There are a set of 5 conditions that if all of them are met, not just one or some, but all of them, then recycling has happened and you're in trouble. Even if just one of these conditions is a no, then recycling has not happened and you're in the clear. Here's a list of conditions. Number 1, payment of tax-free cash. Is the individual planning to take, or have they taken any tax-free cash? Stands to reason that in order to recycle tax-free cash, you have to have received it. Number 2 is the amount of tax-free cash. Is the amount that you've received in a 12-month period more than £7,500? Number 3, a significant increase in contribution level. Have contributions into your pensions increased by more than 30% over what might be expected? What might be expected? Well, to calculate this, HMRC measure contributions over a 5-year period. The year that you're making the payment, 2 years before, and 2 years after the payment. This just stops you making a really big increase to payments just before you recycle your tax-free cash, because you'd have to keep the payments up for 2 more years potentially. Number 4 is a contribution increase greater than 30% of the amount of tax-free cash. The increase in contribution amount only warrants attention from HMRC if it amounts to more than 30% of the tax-free cash taken. Note that the pension payment doesn't have to be made out of the tax-free cash. If you borrow, say, to make a payment, and then you pay off the loan with your tax-free cash, that will still count for calculating whether recycling has occurred. And then finally, number 5 is pre-planning. This is a little bit tricky to define and even trickier, I think, to prove. Essentially, though, it has to have been your intention to use your tax-free cash to increase your pension contributions. I'll put a link to the HMRC pages on this point specifically, but crucially, the onus is on HMRC to prove that this was the case. It was your intention to recycle tax-free cash. The onus is not on you, the individual, to prove that it wasn't. And remember that all 5 of these conditions have to be met for tax-free cash recycling to have occurred. So even if all the others were a yes, this pre-planning condition has to be met for you to get in trouble. Okay, we're going to look at 3 scenarios sent to me by email to see if tax-free cash recycling has occurred. But before that, if this video has been useful for you, then please hit the like button. Subscribe to the channel if you're not already. Not only does this make sure that you keep up to date with the videos we post, especially if you hit the little notification bell, but it also helps the channel to grow because it feeds the almighty YouTube algorithm, and for that, I'm grateful. Thank you. Okay, here's case study number 1. Let's say a person takes benefits from a DB pension scheme, including a large tax-free lump sum. He remains in employment and he wants to reduce his tax liability, and so proposes putting his salary into a new pension. He's worried about pension recycling and has read the HMRC rules, but he thinks this is just good financial planning. He doesn't think he's taking advantage by gaining tax relief twice, as the salary is new income. I know the rules mention the increased contribution must not be more than 30% of the PCLS. I don't think it is pension recycling, as no advantage is gained. Okay, thinking through our conditions here, the person has received tax-free cash, and as he's used the word large in the email, we can assume it's more than £7,500. So our first 2 conditions are met. Now, if the increase in contribution is more than 30% of what it was before, then potentially that's a yes too. Contributions here, by the way, means all contributions into a pension. That's employees, employers, and third-party payments. Now, if the increase is more than 30% of the tax-free cash, then that could also be a yes. We would need exact numbers to be sure. So that's 4 out of 5 conditions met. So the final condition that needs to be met would be the pre-planning condition. And I think the person would probably be okay here purely on the basis that they are anxious about falling foul of the rules. But I would challenge the contention that no advantage is gained, because if you're increasing your pension contributions, you're getting more tax relief. If no tax-free cash was taken, then the increase in tax relief would be offset by the tax being paid on the pension. But tax-free cash is what makes all the difference here, and that's why the recycling rules exist. I think on balance, I'd probably say that this would not be deemed to be tax-free cash recycling, but it isn't me that gets to decide. Okay, here's example number 2. A person remains in work, earning over £60,000 a year. Person wants to start a SIP and pay income from employment and $60,000 from tax-free cash into a new SIP. The lump sum payments will be made over 2 tax years, March 23-24 and April 24-25, so different annual allowance years. If the lump sum payment into the SIP is less than 30% of what was received as a PCLS and subsequently receives tax relief, is this within the current rules on pension recycling? Again, let's work through the conditions one by one. Probably the first 2 are met. Tax-free cash has been received, and if he wants to contribute $60,000, then it's definitely more than $7,500. If the contributions have increased by more than 30% of what they were before, then we've got another yes. According to the question, the tax-free cash is apparently less than 30% of the total lump sum received, and so this 4th condition is a no. And we can stop there. Tax-free cash recycling has not occurred. Finally, example number 3. I have taken maximum lump sum from a DB pension with the intention of passing most of this to my daughters for house deposits and keeping about a third for rainy day cash in a savings account. I am still working through my own company, and with the removal of the lifetime allowance, I can restart contributing to a DC pension through a combination of salary sacrifice and employer contributions. Then I read about the recycling rules, which I don't want to fall foul of. I haven't pre-planned to do this, particularly as I didn't expect to be able to, as I'm over the previous lifetime allowance. But can I do this and stay the right side of the rules and not live in fear that HMRC will come knocking? Well, again, back to our conditions. We can tick off the first 2 in pretty short order. This person says they are restarting contributions to the SIP, so I assume that they've been paying in little or nothing recently for fear of the lifetime allowance. In which case, the increase of more than 30% condition will definitely be met. Now, they say they want to keep about a third of their tax-free cash for a rainy day fund, with the other 2/3 going to their daughters. Well, 1/3 is 33%, so that would satisfy condition 4. And then we're back again, once again, to pre-planning. HMRC would have to prove this person had the intention to recycle tax-free cash. But an easy fix here, which makes that last condition moot, would be to keep back not just about a third, but 29% of the total tax-free cash payout. That way, condition 4 is definitely a no. HMRC can't come knocking. Now, before we look at the consequences of pension tax-free cash recycling, let me just tell you about Meaningful Academy Build Wealth, which is my most distilled and focused learning on how to, well, build wealth for yourself and for your family. There are tons of video lessons in the course, there are calculators, worksheets, live Q&A calls with me, and a thriving community of people in the same boat, all looking to help each other out. And all this is for a one-off cost, and included in that cost is 1 year's access to the same financial planning software that I use every day with my clients, and I will teach you how to use it. You can find out much more at meaningfulacademy.com/buildwealth, and if you decide to sign up, remember to use the coupon code YouTube for a decent discount. I'll see you inside Meaningful Academy. Okay, let's think about the consequences. I mean, I think it's pretty hard, actually, to meet all 5 of the conditions to have your contributions deemed to be tax-free cash recycling. But if you do meet all 5, then the penalties are pretty steep, and they could include an unauthorized member payment charge of 40% of the tax-free cash that you've paid in, an unauthorized payments surcharge of another 15% on top of that, making 55% in all. A scheme sanction charge, that's paid by the pension scheme, not you, but that could be a charge of 40% of the tax-free cash that you have paid in. And if a pension scheme is like a repeat offender in allowing such payments, then they could be deregistered, and there could be a deregistration charge of 40% of the scheme assets. Now, not all of these will happen automatically, and there's obviously an appeals process and stuff, but you can see why you have to certify when you make a payment that you're not recycling tax-free cash. The scheme is on the hook potentially, so they'll do what they can to make sure that you have made the payment in good faith. So in conclusion, 4 out of the 5 conditions are not grey areas. They are hard and fast, yes or no, or number-based conditions. So it's the pre-planning condition then that is the hardest one for HMRC to prove, and that I think will be the saving grace for many people. Okay, I hope that's clear and helpful. If it is, you know what to do. Like and subscribe like the lovely people that you are. Thank you so much for watching. I'll see you in the next video.